So shall we maybe get started? Yeah? Okay, well, I think, one or two more people may arrive in, but yeah, thank you everyone for being here. We might as well kick off now. I've just coming up on 5 past, so thank you everyone for coming. My name's Luke Holland. I'm the network coordinator at Tax Justice Network. I'm joining you from Paris, and there's a really bright skylight above me, and so apologies if somebody pointed out to me in a meeting earlier today that I look really angry because I was sort of squinting. So if I've got a squinty face, it's because of the sunlight. It's not because I'm grumpy. But yeah, thanks for coming along to join us today and to talk about the corporate tax haven index. I feel I'd like to say, I mean, especially thank you to everyone for their interest in the index. There's kind of no question that TJN's work wouldn't have anything like the kind of impact it does have if it wasn't for all the support we get from allies and partners, whether that's in promoting the reports and the indices directly themselves, or in using the findings in their own research and advocacy. And a special thanks to Olivia and the folks at Eurodad for helping organize this. I feel like in my role, I pester Olivia and Toby at Eurodad frequently and regularly. So always grateful for your help and support. So yeah, anyway, I mean, I think as a lot of the Corporate Tax Haven Index is a ranking of the jurisdictions most complicit in helping multinational corporations underpay and their corporate income tax. So today we'll be hearing from Moran Harari, who's the lead researcher in TJN's secrecy team, and Lucas Mian, who's a senior researcher, and they'll be taking us through the research, the methodology of this latest iteration of the CTHI, and talking a bit about what the different indicators in the CTHI actually mean and what they tell us. They'll also be talking about the findings of this year's index and what they sort of reflect in how the ecosystem of corporate tax havenry is evolving. I think we'll also be hearing a bit about how the CTHI methodology compares to approaches used by some other institutions like the OECD. So they'll be talking all together, I think, for about 45 to 50 minutes, and then we'll have some time for Q&A. There's a raised hand function at the bottom of the screen, so when we get around to the Q&A, please feel free to just to put your hand up, and we can hopefully answer any of your questions in a way that is useful and makes sense. And that's probably quite enough from me because I'm the least expert on the CTHI in this meeting. So I will hand over to Moran.
Hello, everyone, and thank you for joining. We're gonna speak, as Luke said, on the second edition of the Corporate Tax Haven Index. Can you hear me properly? Yeah, okay. So as you know, we launched the index last month on the 9th of March. Lucas and I will divide the slides between us. And let's skip in. So we're going to start with, I know some of you are already familiar with the index, but for the sake of those who are not, we're going to explain about the concept of the index. And then we focus some of the 20 Haven indicator. We're going to, after explaining, we're going to focus only on some of them because we don't have time. And then we present the general ranking and our key observations and recommendations. And we're planning to speak about 50 minutes, as Lucas said, maybe 1 hour. If you have any questions, please feel free to put them either on the chat or raise the hand, and we will address them at the end. So, as you know, illicit financial flows involves money from individuals and entities, and it may have legal or illegal origins, and they are often used in tax havens for different reasons, and different facilities they're offered. So it can be either for financial secrecy reasons, such as to hide someone's assets or identity as part of corruption, money laundering, tax evasion. And these issues we address in our financial secrecy index, which you all know. However, tax havens are also used very often, not necessarily to hide something, but simply to reduce the tax rates. Many multinationals use tax haven rules for profit shifting or to avoid tax. So in the corporate tax haven index, we actually designed it to complement the financial secrecy index. And while in the financial secrecy index, we focus mainly on indicator related to tax avoidance and anti-money laundering. Here in the corporate tax haven index, we focus mainly on tax avoidance, spillovers, and race to the bottom. So the index ranks the jurisdiction by their contributions to global tax avoidance risks. It ranks each country based on the intensity that the country's tax and financial systems allow multinational corporations to shift profit out of the countries where they do the business. In the first edition, we started with 64 countries. And for this edition, we added 6 Latin America countries. How do we choose the countries? We included all EU countries. And we took the major misalignment jurisdictions and jurisdictions which we have indications for a major role in profit shifting. And we also took African countries and Latin American countries that we are committed as part of our project. So the index structure is similar to that of the financial secrecy index, as I will explain. Like the financial secrecy index, we have 2 components. So the Haven score, like the secrecy score, is the qualitative component. And it is based on the assessment of the legal framework of the jurisdiction according to 20 indicators. We measure how aggressive the tax rules and policies of those jurisdictions. And the higher the score, the bigger the potential risk to become a profit shifting destination, and this way to erode the tax base of other jurisdictions. The other component is the quantitative component. This is the global scale weight as we have in the financial secrecy index. It measures the multinationals' activity in each country based on inward and outward foreign direct investment data. So in other words, we measure what a jurisdiction's share of the global bilateral FDI as reported by the IMF. And the combination of these 2 components in accordance to a specific formula you can see there. This is the way we gain the Haven score, the corporate tax haven index score. And this is how we rank the jurisdiction. So similar to the financial secrecy index, a higher rank on the index does not necessarily mean that a jurisdiction's corporate tax laws are more aggressive, but rather that the jurisdiction it plays a bigger role in enabling profit shifting. And as a result, a highly tax aggressive jurisdiction like Anguilla, which in this edition it ranks 39, and so if the Anguilla facilitates a small volume of financial activity, but it is more aggressive and it's slow. But we compare it to another country like Belgium that is ranked 16, then the reason is because the volume of the multinational financial activity is higher. So the qualitative component is comprised of 20 Haven indicators, and these indicators are classified into 5 categories that are equally weighted. But as you can see here, some of the categories have like 5 or even 7 indicators, and some categories like the LACIT, the lowest available corporate income tax, and the tax treaty aggressiveness have only 1 indicator. So it means that the weight of them is higher. And also in this index, we assess all the indicators according to the weakest link. So the least transparent or worst option available in the jurisdiction. This will determine the indicators having score for this specific jurisdiction. Here you can see we try to put them on a Y and X axis. The Y axis reflects how flexible or maybe specific the indicators are capturing tax avoidance risks. And the X reflects the level of tax avoidance risk that the indicator measures. So you can see that the double tax treaties and the LACIT, they create more tax avoidance risk, and therefore they are more close to the high X axis. And also we have the traffic light colors, so you can see the red are the countries that the indicator that countries should prevent from doing, and the green ones are the ones that countries should adopt, like transparency indicators. And similar to the financial secrecy index, we also, all the answers that we have to the indicators, they are all references, they have sources, we explain them in the notes, and you can see all in open data, so all data is downloadable. So these are the indicators that we're going to focus on, mainly on the LACIT, the 5 and the 6, and the 20, the double tax treaties, the 7, the patent box, and we also touched slightly upon some of the transparency indicators. So let's start with the lowest available corporate income tax rate, the LACIT as we call it. So as you know, much of the research about tax avoidance and race to the bottom rests on the statutory corporate income tax rates. The problem is there are two factors that usually distort the findings. So the available data sets that we use, and the OECD ones and the KPMG, they are often misleading because they present the highest corporate income tax, but in fact, there are other rules that might reduce the tax rates in specific case and are not mentioned, although multinationals, they do consider them when they choose where to invest. And the other factor is that these rates, they ignore the tax base. So in the corporate index, in the corporate tax revenue index, we treat the tax base and the tax rates as equivalent. And if you look at the example here, the lowest available corporate income tax rate, the LACIT, will be the same for a jurisdiction that have with a corporate tax rate of 1%, or with a jurisdiction that the corporate tax is 10%, but it actually exempts the 90% of the company's income. So Malta maybe is a good example to explain it, because it has a higher statutory tax rate, but this tax rate is artificially lowered based on the automatic tax refunds of 86%. If the company distributes the dividends, and the resulting of this tax rate will end up with 5% rather than 35%. So in this indicator, we actually try to create like an alternative data sets that derive through the legal analysis that I will explain in a second. So it's a very packed slide, but I'll try to explain it one by one. How do we determine the real corporate tax rates for that multinational can pay in a certain jurisdiction? So the starting point there on the left is the statutory tax rate, but we then look at any corrections, as we call it, like the size of the company or the sector or the region, whether they have like specific tax rates. Or we look also at adjustments such as the profit retention, which I just mentioned regarding Malta, or whether there are specific types of companies that are allowing lower rates. We also look at the unilateral tax ruling that some jurisdiction provide to companies. And some of them we could also see the tax rate in the EU state aid cases that were published. And for this edition, for this second edition of the index, as part of step 3, you see there, we did add a component of the corporate tax residency scope. And there we penalize countries whose definition of tax residency does not include at least all companies incorporated under its law. So these are the 3 steps that we do at the beginning. This is legal analysis. And once we have the rate, we compare it to the lowest rate. We compare it to the spillover reference rate, which is 35%. Now, given that in this index, we look at negative spillover tax, the underlying assumption is that any democratic country is able to decide on the specific corporate tax rate. And therefore, we expect, like any other country with lower corporate tax rate, will create a negative spillover effect on the other jurisdictions. So we take that corporate income tax rate, the reference spillover tax rate of 35%, and then we compare it to the LACIT rate of every country that we found. So, for example, if a country has, we end up with our legal analysis with a rate of 35%, the Heaven score for this specific indicator will be 0%, which is the best. And the other way around, if it has 0%, then it will have the full Heaven secrecy score, and anything in between will be proportionate to that. So just to expand a bit on the new component we added to this indicator, well, we consider that both effective management and place of incorporation, both of them should be like triggers for tax residency. We think that in the very minimum, and that's what we did here, a country should take responsibility for companies that created under its specific law. But we found that in various jurisdictions, locally incorporated companies do not necessarily consider tax residents of the jurisdiction. And we think that it allows a dangerous loophole because companies may end up with not being considered tax residents of any jurisdiction. So maybe some interesting example we found, for example, a company that is created under Cyprus law, and which is actually effectively managed in Macau or in another country, there is a situation that it may not be considered tax residents of neither of the two jurisdictions, and that their foreign income will not be taxed in those jurisdictions. Now, interestingly, we found that some jurisdictions are starting to close their loopholes. So Montserrat, for example, abolished the international business income, the company's type after the OECD pressure, but still it keeps the residency loophole. And some jurisdictions, like Mauritius, they closed one loophole. So Mauritius recently abolished its global business license companies, but in parallel, it opened a residency loopholes because the new locally incorporated authorized companies that it created, they are not considered tax residents wherever they are created. These are the results of some of the jurisdictions. You can see here that these are the corrections and adjustments that we have. And we always keep the lowest available rate. So if a country has like one specific rate in one correction and the other adjustment, we take the lowest one according to the weakest link. This slide compares the LACIT to the LACIT result to the statutory corporate tax rate. And as you can see, there is kind of a huge gap between the statutory corporate income tax and the LACIT for many of the jurisdictions. And it can be related either to a specific correction, like the territorial tax system. Gibraltar, for instance, has a territorial tax system, or it can be related to the adjustment, like Belgium for the tax ruling, or Mexico for not having a sufficient residency rules. And you can see in the specific detail of each jurisdiction, the explanation. Here I will slightly touch upon the category of transparency. We have there 5 or 6 indicators, and I will focus on 3 of them. So this indicator number 11, here we assess whether a jurisdiction ensures that its own access to the country-by-country reports of foreign multinational with domestic operation, what we all call local filing, right? So we know the BEPS Section 13, and for this index, we consider that access to those country-by-country report is ensured if the jurisdiction requires the local filing whenever it cannot obtain these reports through the automatic information exchange of the BEPS mechanisms. And we consider that there is a robust filing of local country-by-country reporting only if the jurisdiction goes beyond the legal framework proposed by the OECD. Now, following continued pressure from the OECD on governments to water down their laws on local filing and to match those of the OECD, we saw the 2 countries, Germany and Spain, have also weakened their laws to match the OECD standard. So in fact, now, since 2018, there are already 11 countries that water down their local filing. And if we can see here, the 2 countries in blue, France and Taiwan, are currently the only countries that we identify that go beyond the OECD standard. Whereas all the other countries, if they are in yellow, that means that it's according to the OECD standard, and if they are in red, they don't have any. This is have an indicator 12, and here we assess the online disclosure of tax rulings and extractive industries contract. So here also we've done a slight change. We tightened the tax ruling component to require more transparency from jurisdictions in this regard. And this is because, well, in some jurisdictions, the level of disclosure on tax ruling increased marginally in the past years. When we actually reviewed those examples, we took the example of the tax ruling, we realized that we need to raise the bar for disclosures for them to be in a real value for the public and for authorities. So we did the tightening in 2 ways. First one, as opposed to the first edition of the index, the jurisdiction that published only some of the tax ruling, we gave them the full heaven score. It's not enough. And this is because it allows the tax administration the discretion, right, to decide which tax rulings they wish to disclose. And as a result, there are tax rulings that the public may be interested to see, but they will not be online. And even more, the discretion right can be potentially abused by those authorities to hide certain rulings from the public. And the other thing we did is that jurisdictions that do not publish the full text of the tax ruling, but rather just a summary or extractions, then we gave them a higher heaven score. And finally, have an indicator 13 here. We have 2 components. So the first one, we assess whether a jurisdiction requires the taxpayer to report tax avoidance schemes they use, and also in parallel whether they require a tax advisor to report the tax avoidance scheme they sold or to companies. And the second component assess whether a jurisdiction requires taxpayers and tax advisors to report uncertain tax position for which the reserves have been created in their corporate accounts. Now here, the slides you see here refer just to the first component, and as you can see, in orange, many European countries do adhere to the mandatory disclosure rules, and they oblige only the tax advisor to report on tax avoidance schemes, but countries are allowed to extend the scope, even according to these scopes. And there are 5 countries that you can see here in blue: Portugal, Poland, Ireland, Croatia, and Malta, that require both tax advisors and taxpayers to report the tax schemes. And now I will give the permission to Lucas to continue from here.
Thank you very much, Moran. So I'm going to continue with Haven Indicators 5 and 6 on tax incentives or exemptions. So we do like a first distinction between permanent tax exemptions and those that are limited in space or time. So like for purposes of like putting like the bar somewhere, incentives that are awarded for longer than 10 years are considered permanent. So for instance, Singapore's pioneer tax incentive can be awarded for more than 10 years. I think it's up to 15. So like the common factor between these 2 indicators, the one on permanent exemptions and the one on tax holidays and economic zones, is that we only cover profits-based tax incentives, which I will explain now. So an additional indication is that for permanent tax exemptions, in order to be able to properly compare one country to the other, we assess whether there are full exemptions or partial exemptions across different economic sectors. And this is to allow for like a consistent a comparison of tax regimes. For instance, like a country can have like a single tax regime that has like a very wide coverage that covers many economic activities. Some other countries can have 3 very narrow incentives that are awarded in the same economic sector. So like if we don't have this sectoral approach, we can penalize the country that actually has a narrower or like less tax incentives. Okay, so going on to the next slide, please, Moran. The distinction between cost-based and profit-based tax incentives. So according to this 2015 report from IMF, OECD, etc. So cost-based tax incentives are those that are conditioned on an expenditure by the company. So if the company does not have like a specific expense, the company does not get the tax advantage. So for example, like super deductions for costs. So if the company buys equipment to let the company have like a 200% deduction on that cost, would be a cost-based tax incentive, or lower tax if the company continues to hire more people every year. On the contrary, profits-based tax incentives are those that are simply like by the like a lower tax rate that is awarded to a company that is merely like that can, for example, declare that its field of activity is in a specific sector, or that it otherwise qualifies, without requiring any expense by the company. So like as the IMF and company says, like a profits-based tax incentives make an already profitable investment more profitable, and thus like it's not like so like the presence of these profits-based tax incentives does not create positive spillovers necessarily for local local economies, and this can be very damaging. For example, for African countries which lower their tax rate but not necessarily increase like the level of activity in a specific sector. So the next slide, please, Moran. So here is like a little table that categorizes incentives based on whether they are limited in time or space. And on the right hand, you can see cost-based tax incentives. So not only capital allowances, but depreciation, investment credits as well. And final point, even if for purposes of narrowing like the scope of the research, we do not cover cost-based tax incentives because we consider them, as the IMF, to be less harmful for global spillovers than cost-based incentives, but cost-based incentives can also be harmful. For example, like capital allowances for fossil fuel companies, for example. They destroyed the world, yes, but they are cost-based. So like this, like a caveat. Next slide, please. With regards to Haven Indicator 5, so that indicator measuring permanent exemptions more than 10 years. So this is like a quick overview of different countries we cover. So like you see in the top lines, well, in the header, you see like the different economic sectors that we use, which are based on like the statistical classification of a Eurostat and the UN one, with some changes, minor ones. So the first three countries, Cayman Islands, Estonia, and Monaco, even if they might seem very different from one another, they all have in common that provided certain legal framing, that the company does not pay tax in any of in any economic sector. So like Cayman Islands, as we know, does not have corporate income tax. Estonia does not have a corporate income tax upon accrual. So if a company earns money but does not distribute, there is no tax on companies in Estonia, a European country. And also a European dependent jurisdiction, Monaco, does not levy tax in any economic sector, provided this 25-75 split between domestic and foreign income. So if 25% or less of the income is foreign, no one pays tax in Monaco. Going on quickly, Mauritius has this new company that Moran mentioned, the authorized company, which is considered non-residents, and thus the effective tax is zero. And going on to best cases in the EU, Sweden, for example, where only financial investment is partially exempt. On the bottom, you can see the overall statistics. Everyone exempts to some extent financial investment. You can see 99% of the jurisdictions where investment funds pay less tax than probably the bakery on the corner of the street. Next to financial investment with 99%, there is a real estate with 76. Oh, please, Moran, can you go to the next slide? There is a little color. Yeah, here we go. And the other sectors which we see that are heavily exempted are transportation and storage and business services, but also banking and insurance and extractives. Curiously, transportation and store, like both the investment sectors, but banking and insurance, business services, and transportation and storage are all what the OECD calls a geographically mobile financial and business services, blah, 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 which is in theory like the focus of their harmful tax practices monitoring. Yet, however, we see that there are a wide range of harmful tax incentives that are not covered in the OECD harmful tax practices monitoring. Next slide, please, Maureen. Yeah, quickly, like the results here, you see like how often countries in our sample that I remind that we cover close to 90% of global foreign direct investment in our sample. So this is really kind of like a good overview of what goes on globally. Most countries fully exempt companies active in the investment sector. And next slide, please, more. And within the active sectors, we see like a split, like on the right hand red countries, there are many of them are zero tax countries. We can also see Estonia, as I mentioned. Latvia has the same tax system as Estonia, and a whole bunch of like heavily countries with heavy tax incentives like Singapore, Panama, Lebanon, etc. Next slide, please. Okay, so going on to incentives that are limited in time and space. Quick reminder that incentives is like any tax rate that is lower than the statutory rate. Temporary is under 10 years and geographically limited. Here we do like a distinction between what would be like a central legal authority assigning a lower tax rate to a specific zone, as could be like a free economic zone, a free port, etc. And so we distinguish this from the case of like a federal or cantonal tax system. So in the latter case, we are covering this in the lowest available corporate income tax, but not as an economic zone, meaning that like a Swiss canton is not considered an economic zone. The same Delaware in the US is not considered an economic zone. Rather, their tax rate is considered for the lowest available one. Next slide, please. Quick overview. This is next slide, please. What we see in this indicator is that over and above zero and or no tax countries, there are many African countries at the top, and also, even if I didn't mark them, there are countries like Ecuador, Costa Rica, China, and Singapore, Peru, and France has also a fair amount of geographically limited exemptions or temporary ones, for example, for startups and things like that, the first X years of operation. Next slide, please, Martin. Patent boxes. So this is Haven indicator 7, and we use as definition of a patent box zero or lower tax applicable to income from intellectual property. So this includes like royalties in general, income from copyrights, IP licensing, etc. So like a further specification that we ask is whether the patent box, if it has been monitored by the OECD, if it considers that it has nexus constraints. Next slides, please. Yeah. So here we can see like a very marked difference between our methodology and the OECD's, meaning that, for example, In Hong Kong, because Hong Kong has a territorial tax system, all foreign income is in principle, I mean, like not all subject to case law, blah, 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 but foreign income is not taxed. It's the same in Costa Rica and Seychelles. So like with the OECD's relative assessment, the OECD asks, are royalties taxed at a lower rate than other types of income? Well, in Seychelles, in Costa Rica, and in Hong Kong, no, because foreign royalties are taxed exactly in the same way as foreign interest, for foreign dividends. All of it is taxed zero. But what we ask is like a rather like a question for an absolute assessment. So like, what is the lowest tax rate applicable to royalties accrued in the jurisdiction? And for these three countries, it's 0%. Thus, we consider that there is a patent box. Next slide, please. Yeah, so in green here, flashy green, you can see all of the jurisdictions where you can accrue royalties at 0% rate and which are not covered by the OECD patent boxes. Next slide, please. Okay. So going on with category 5. So this is Haven indicator 20. As Moran showed previously, this is together with LACIT the indicator that has like the highest impact on the Haven score of a country, because it's like the only indicator within its category, and then categories are averaged and the qualitative component is combined with the quantitative one. So tax treaty aggressiveness. You can see in the left the situation of Rwanda. Rwanda has 5 tax treaties with Singapore, Jersey, Belgium, Mauritius, and South Africa. This diagram covers dividends. So here we see that like under the tax treaties in force between Rwanda and Singapore, Jersey, Belgium, blah, 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 there are different tax rates. So what we do is we compare each bilateral tax rate to the tax rate otherwise available in the jurisdiction. So what if Rwanda didn't have this treaty with Singapore? What would be its average treaty rate? And so by doing this, we have like a dynamic assessment of like how much each treaty actually restricts the taxing rights at source jurisdictions. So, for instance, here Singapore and Belgium clearly have like a higher impact in reducing the taxing rights of Rwanda, because companies can repatriate dividends paying lower tax. So you can see in the table on the right, like how this example would play out with the formula. Also, like a particular aspect of this formula, as you see, is that like we consider the difference in this tax rate applicable under the treaty, the difference between this and the average otherwise available in the jurisdiction. We only consider this amount when it is negative. So when the treaty has actually lowered rates than the average, and we do not, for instance, give like a positive score to South Africa for having a 15% rate. Why? Because there is no race to the top in tax treaty rates, meaning that like tax treaties, what they do is they restrict source tax rights. They cannot like raise them. So like if South Africa enters into a treaty with Rwanda at 15%, this does not mean that like the dividends would be taxed like at that rate, but that there is an option under domestic law. Next slide, please. Yeah, so the subject matter of this is not only dividends, as I showed in the example, but also interest, royalties, under bilateral and multilateral treaties. Multilaterals such as the West African Economic and Monetary Union, Arab Economic Union Council, and European Union directives, which are rather multilateral in nature. And the data sources that we use are mainly IBFD withholding tax rate tables, and we read the treaty language where applicable or confusing in IBFD tables. Yeah, so one final thing is that like for jurisdictions that have like a no tax or 0% tax system, we assign them in this indicator a 100% score. This is because even if they might not have many treaties, they can act as a very important players in global treaty networks, acting as our fellow researcher Javier García Bernardo has studied as a sink jurisdiction. So those countries where money goes to die, let's say, to stagnate. So, for example, Bahamas, Bermuda, Isle of Man, Jersey, and Guernsey have 0% tax systems, and they have 100% score. Curiously, the United Arab Emirates wins by all measures, meaning that like it because it has like a 0% tax system, we would assign it a 100% score. But even if we didn't, the width of its very aggressive tax treaties awards it, the UAE the highest score. All the other scores are normalized with in relation to the United Arab Emirates. On the right, you can see the average aggressiveness per treaty. So here you can see a pretty interesting insights. Not only that the UAE is also significantly aggressive by treaty, but that many of these jurisdictions like the Isle of Man, Jersey, and Guernsey have so like the few treaties that they have are extremely aggressive. Also, takeaways from these, colonial powers are the ones that have the most aggressive treaties. Former colonial powers, France, the UK, also Spain with regards to Latin America. Okay, next slide, please. Yeah, so these are like the results here. EU countries. Next slide, please. OECD countries, other OECD countries, and next slide. OECD dependencies. So these are like current colonies. So like within these three groups, you can see that we cover like almost like all of like the top 1, 2, 3, 4, like 30, and the UAE. Yeah, I think that's next slide. Okay, yeah. So finally, on the index construction, after having collected like the data for each indicator and ensuring that within each indicator the data is consistent, meaning that we are not having like a different standard for a country in lowest available corporate income tax and another country in lowest available corporate income tax. But this is not enough, meaning that like we are assessing systemic characteristics of jurisdiction's tax system, and it's fair to think that, for example, foreign investment income has a relation with the taxation of investment funds, or that also capital gains tax rates has an impact on the taxation of investment funds, or that taxation of royalties and patent boxes have a relationship. So like all of these interactions are covered in a final assessment that would, next slide, please. final assessment that we do between different indicators. So like the cells in red are like the different consistency checks that we have across indicators. As you see, Haven indicator 1, so the lowest available corporate income tax, interacts with almost all other indicators, meaning that if a country has an effective 0% tax, there are many things that are different in the assessment, for example, of tax rulings. Should we assess tax rulings on a country that does not impose tax? Well, no. So this is an interaction between two indicators. Also, as I mentioned, investment sector, patent boxes, and other. And that's it for me. Thank you.
So thank you, Lucas. Briefly speak on the results. So you may have seen this slide. These are our top 10 on the index. The top 3, as you can see, is British Virgin Islands, Cayman, Bermuda and Cayman. And they are followed by 2 European countries, Luxembourg and the Netherlands. Now, Cayman has moved up from the 3rd place that it was in the 2019 edition. And this is because it increased the volume of financial activity it hosts from multinational corporations by nearly 15%. And this way, increasing its global role in enabling profit shifting. The United Arab Emirates entered the top 10 this year after multinational corporation rerouted over $218 billion foreign direct investment from the US and from South America through the Netherlands and into the United Arab Emirates. And this shift, we explain partially by the growing role of the UAE as an offshore financial center of choice for the multinational that operate in Africa and China predominantly. As for the OECD countries and their dependencies, they are responsible for 68% of the global corporate tax abuse risks. If we just unfold it, so the OECD countries are responsible for 39% and their dependencies are responsible for 29%. And if we translate it to money, this is data we found on our State of Tax Justice report we published in November last year. It equals to $166 billion. And you can see here how many things we could potentially do with this money. It is also worth saying that the lion's share, 31% of the responsibility among those OECD countries falls on, again, the UK and its network of overseas territories. After the UK, the countries that are worth mentioning is the Netherlands with 5.5%, and then the Switzerland, and then Luxembourg. These are on the top 10. We also found, and Lucas touched that briefly, that countries that are graded by the OECD as not harmful, they are responsible for 98% of the world's corporate tax abuse risk. So in comparison, if we take those that are graded as harmful, they only account for 1%. And the countries that are under review, according to the OECD, they also account for 1%. So again, if we translate this to annual corporate tax that we lose by enabling multinational corporations to shift their profits, then countries graded as not harmful by the OECD, they cost the world $239 billion, where countries that are graded only as harmful, like cost the world like $5 billion in lost corporate tax. So there's a huge gap here. If we look on the EU countries, so out of the top 25, not top 10, there are 9 countries that appear there. And we can see that the risk for corporate tax abuse supplied by all of the EU member states is equal to 38%, which is very high. And if we compare it to the less than 22%, then less than 2% I showed in the last slide, then the gap is even higher. Now, if you take the Cayman is providing 6% of this responsibility, and we all know that Cayman was delisted from the EU tax haven blacklist last year after a major campaign. Over to you, Lucas.
Yeah, thank you. So yeah, so like the key takeaways would also be that like that we have to move away from a binary determination of what a tax haven is. So like a country can be a tax haven for many different reasons, and I think that the corporate tax haven index successfully covers most of those risks. Finally, like there is also like a very high relevance of the first indicator of the index, the lowest available corporate income tax, which actually interacts with many of the key aspects that make like a jurisdiction like a good destination for multinational companies, and has actually like a higher econometric predictive power than top statutory rates. I mean, like who like no econometric model would find that like an agent corporation would go to Malta with its 35% tax rate, and the reason is that they go precisely because the tax rate is not 35% but 5%. And finally, as well, the relative versus absolute nature of the assessments. This is one of like the of the main problems of the OECD harmful tax practices monitoring, which creates like as many double standards as there are jurisdictions in the world, notably having different standards for countries that don't have any tax and countries that have a tax, or yes, the patent box examples that I shared previously. Next slide, please. And yeah, and from like an a international tax policy perspective, we believe that that the OECD should leave like the tax policy space to new UN bodies under a UN tax convention, and to make sure that we have global tax rules to be relied upon, and to move away finally from last century's principles like the arm's length principle and other legal fictions that do not serve our time. Thank you very much. I think we are done. No. Nice materials on the website. This is very, very thrilling. So we have country reports where you can see all the data indicator, but by indicator, with like a quick summary of how like the country stands in the world, how big of a role do multinational does the jurisdiction have in the global foreign direct investment scene, and how bad of a country it is in tax avoidance terms. We also have interactive maps, which are fun to play with, and you can see different things there. And you can also, of course, download all the data for free if you're not using it for profit. Otherwise, you have to pay. And That's it. Yeah, thank you very much.
This fabulous interactive map is also, we are grateful for TJN and Norway that help us to design this. Thank you very much. We are open for questions.
Okay, thank you so much, guys. That was very enlightening for me. My background is in human rights as opposed to this complex econometric stuff. So even though I work for TJN, I don't necessarily understand everything. So anybody have any questions they'd like to pose? Please feel free to click on the raise hand button at the bottom of your screen, and maybe I can call it you. Oh, Sigrid.
Yes, hello, can you hear me?
Yes, indeed. Please go ahead.
Yes, I wrote my question, but when you said that we could pose it orally, I jump on the opportunity. So I just wanted to say, first of all, thank you so much, Moran and Lucas, because you really blow me away on the knowledge and all the knowledge that's behind this index, and we use it all the time in all our policy work. It's such an amazing building block for everything we do. So yeah, just fun, and it's amazing. So I also have a question. I was just, Norway is not rated, so I'm also a little bit curious if Norway will be included in coming indexes. But just like in a general question, then, if a country like Norway has a tax exemption for just one sector, the shipping industry, where we have 0 rate, and I kind of vaguely remember that maybe in the previous index or so that you needed more exemptions in more than one sector for it to kind of count. I was just wondering if this is the case still, or if there has been any changes in that. Thank you.
Thank you, Sigrid. So indeed, so like tax exemptions, like the one that you mentioned, are always taken into account if there is no like cost requirement, but they only spill over into the lowest available corporate income tax if there are 4 or more sectors that are exempt. So like in the case of Norway, if it is like the only sector fully exempt, it would be taken into account for Haven Indicator 5 on sectoral exemptions, but it would not show for the lowest available corporate income tax.
Thank you.
And I would add about Norway, it's still early to say if we include it in the next edition. We hope eventually, of course, to include all countries, but it depends on resources.
And I think we have a question from Anna Hench. I hope I haven't mispronounced your surname. Would you like to go ahead?
Yes, hello. I don't know if you can listen to me.
Yes, we hear you.
Yeah, hello, and thank you very much for the presentation and the elaboration and sharing all the materials. It's very useful for me to know how you build your index. And my question goes regarding the negotiations at the OECD on the recent announcement of the US Treasury and certain European countries to put a minimum tax rate on multinationals. How do you see this would affect the country's tax basis, tax rate? Hopefully, I hope it will be raising the tax bases and tax rates, but will it be a race to the top as we all expect? How will this affect? And also the relation with the tax exemptions, because depending on how this minimum tax, in case is agreed, is taken, it will affect the distribution of the taxing right between countries. How will this affect, do you see, could affect developing countries? And also on tax exemptions, as we know, the tax exemptions sometimes are required by countries, by donor countries, even exemptions on ODA and on some tax laws. So you know, in case everything is agreed, how do you see what other things should be moving on apart from or beyond this negotiation? Thank you so much.
Thank you, Lucas. Maybe you want to answer this on the tax exemption angle, and I can answer on the last one. The tax exemption, I think, is more important for your question. Thank you. That's a very good question. I think in the terms of our our lowest available tax rate, it depends if the actual final tax rate will change. So as I explained, we consider the tax rate and the tax base as equal. So if it only affect the tax rate without changing the other perspective, like the tax residency or the country being like a territorial tax system, I doubt if there will be any change in our last indicator. But it can definitely affect on the tax exemptions one, on the patent box indicators as well. And maybe Lucas can answer this one.
Yeah, thank you. So, yeah, so like potentially Pillar 2 could have like an effect in LACIT if there is no circumstance under which the company can pay lower tax, because if there is any such circumstance, we would take into account that and not the nominal minimum tax. With regards to tax exemptions, what was the question quickly? So like if like how do we see this interacting with Pillar 2?
Yes, my question would be that the tax exemptions, I'm not talking about tax holidays, which can be, you know, reversed, but more like kind of tax exemptions. I guess, you know, the US and maybe other countries, they, you know, in case this minimum tax is taken, they will try to get, you know, all the profits from, you know, if for example, in Ecuador, there's no, imagine, or in another country, the Republica Dominican Republic, there is no tax. It will be, for example, Spain, you know, getting all these minimum tax. But imagine that Spain or Netherlands or whatever has, you know, pushed a little bit the country to have a tax exemption. Yeah. This would be, you know, it's like a kind of negotiation, you know, for example, for Dominican Republic to get any tax, it will need to revise the treaties with, you know, on ODA flows, for example, just to revise and get rid of the exemptions, maybe, to get some earnings and some domestic resource mobilization. So how do you see, you know, this negotiation moving? Because it is not just the negotiation on tax, minimum tax, but it is connected with other things and agreed treatments. So how do you see, you know, the possible next steps?
So as you say, there are many moving pieces, among them like the apportionment formula, the significant presence, and depending on like both Pillar 1 and 2, like many tax treaties may need to be superseded, and thus like in order to reach like a an effectively applicable pillar 1 and 2, many things have to change, no? And we can expect to see within like the realm of tax exemptions, probably still some competition to attract economic activity and provide tax advantages to it, even if those advantages are not in the form of a tax rate. So like I think that we will still see tax competition, but the competition will be less hostile and less harmful to developing countries.
Okay, thank you so much, Lucas. It's very good, your answer. Thank you.
Thank you so much. I think we have a question from Arnold. Arnold, would you like to go ahead?
Yeah, thank you very much, Luke. It was a great explanation of all of you, and thanks for this index. It's great to use. In the Netherlands, it got a lot of media coverage, which is helping us move forward. Of course, I hope it also will be like an continuous instrument during the year. So not only like it's like once every 2 years, but actually, yeah, you can constantly look like where you are. Also, learn from each other's best practices when people when countries move down the list. Like, what did they do to move down the list, and can we do that in our country as well? Because that's what we're all looking for, like methods to fight tax avoidance. And then we can do suggestions as well in our country. The question I have is on the reporting of tax avoidance schemes. Well, you have made this distinction, reporting by the taxpayer and the tax advisor. But I actually have two questions there. One is like when you have a ruling, wouldn't that be like similar to reporting? And the other one is, what is actually a tax avoidance scheme? How do you define a tax avoidance scheme?
Thanks a lot, Arlen. Good questions. So just to confirm that I understand the first question, you're asking what is the difference between the tax, or what's the reason for having a tax scheme if the government can provide ruling?
Well, I would assume that if you ask for a ruling, that is also reporting, isn't that, in a sense?
Well, yes, this can be one way, but there are many taxpayer and tax advisors that use or create tax schemes, tax avoidance scheme, or maybe aggressive tax planning, we call it, and they don't report on that. All right, so with the capacity of tax authorities to check the reports, there is a high chance that they will actually miss the companies or the individuals using those tax schemes. And the ruling also, there are lots of companies that can choose not to apply for a ruling, either because they don't want to disclose that they use this scheme, or that they have concerns that if they will apply for a ruling, they will have a negative answer, or the authorities will not authorize the use of this ruling, and they prefer to do that this way, and then to maybe argue at court if this is in accordance with the law or not. So the ruling is one thing, and the use of tax schemes is another. How do you define tax scheme is a very good question, and it varies from countries. So in Israel, for instance, there is a list of tax aggressive schemes that is updated every 3 or 4 years. So you can say, okay, these are the lists that the companies are obliged to report on, but on the other hand, you can interpret and say, okay, I know there are other schemes that I can use. They are not listed here. Are they okay? We don't know, but this is one way to approach it. And the other way is to determine a provision that is a very general. So some countries do that as well, like a general provision. Let's say aggressive tax scheme would be if it includes various components. So this is the other way of doing it. And the reason we also think that it's important for both taxpayers and tax advisors is because a lot of time there is, first it's the responsibility of both, but the ability to match those reporting can flag a lot of other things that maybe the tax authorities is not aware of, and there are discrepancies.
Yeah, just quickly, like to complement, so like in this index we are covering like two different situations, which are secretive practices. So like as you mentioned, like a ruling is an interaction with the tax administration. No, so like we are not considering like the disclosure to the tax administration of these rulings. We are considering the public, so like the disclosure to the public of those rulings. Why? Because it's like a matter of like a equality between taxpayers, and also like a matter of like accountability. If citizens are voting tax laws, they should know if there is any a deviation from what they voted. And the other thing is this disclosure of tax avoidance schemes, which is like a matter of like multinational corporations are conscious when they have an uncertain tax position, because like the certain tax position is always to pay like the tax rate as it accrues. If you're not sure if like a cost that you're booking in this country is actually a cost in this country, don't book it, and you will pay like a higher tax. You don't have uncertainty. So like this is aimed at this like uncertain tax positions, for which many companies, and mostly multinational companies have like a provision for those uncertain tax positions. There is like money in the coffers in case like that position goes wrong. And tax advisors often have like a threshold. They cannot allow that uncertainty to go above 4%, for instance. So yes, so it is that other type of reporting from the taxpayers to the tax administrations that we're also interested in.
Okay, thank you.
Thank you so much. So I have a question here from anonymous attendee, which sounds a bit mysterious. I'm not sure. Would you like to maybe introduce yourself and ask the question, or alternatively, I can just read it out and try to answer? Okay, well, you'll need to raise your hand. Okay. You anonymous. It's funny calling someone anonymous. You need to raise your hand to speak, so as we have to unmute you. Okay, well, maybe I can sort of plow ahead. I mean, the question was, basically about the UN. The UN tax body treaty proposal. It's unlikely that any worldwide agreements relating to countries can be implemented to resolve this challenge. Would it be easier to put in place measures to dissuade corporate entities from making use of tax loopholes in jurisdictions that support tax evasion? And I think certainly from TJN's perspective, TJN has a proud history of demanding the impossible, because it's generally been our experience that when a proposal is made, a new idea is made, it is initially laughed at and mocked, and by Western governments and many others, and everybody tells us that will never happen. And this was the case with with CBCR reporting and automatic exchange of information. Of course, over the years we've seen a lot of progress on these issues. So I think that we would certainly feel that it's not either or. Certainly, we want anything that is going to tighten the net on aggressive tax planning by corporate entities, but we also feel that the idea of having a global agreement under the auspices of the UN is something that's possible. It will probably just be very hard and take a long time to get there. But our experience has certainly been that you can get there in these things if you just keep on pushing for long enough. So yeah, that would be our answer. I think Moran and Lucas can jump in and tell me if I'm completely wrong.
Yeah, you're right. I will just add that some of the indicators, we can already see that countries take a further step, right? So like the tax schemes that we showed, the mandatory disclosure rules of the European Union, they only oblige the tax advisor to report, and the taxpayer is required in certain specific circumstances. However, there are some countries that decided, no, this is not enough. We will require both of them. Or the local filing, right? It's we see a regression there, but some countries required or decided that we need a more robust local filing and took that option. So definitely we would like to see countries independent to decide taking their sovereignty to prevent tax avoidance.
Just quickly, like there is like even so like awaiting for like a global tax convention or like a global agreement. There are unilateral measures that can happen, or even a regional countries can play with the market access of foreign corporations depending on where they are established. So like over and above like the general tax system characteristics that are covered in the corporate tax haven index, that there are like stronger measures that can be held mostly at the regional level.
Perhaps I can also maybe join in here. This is Olivia speaking from Eurodad, and of course, I think we very much echo what Luke has started off with, in that I think a lot of the structural changes that we've sought in the tax justice community were considered completely impossible and really blue sky thinking. And then we push and we push and we use the political opportunities we have. And we've actually achieved a whole lot of them. I mean, I've only been part of this movement myself for, less than 10 years, and we've got registers of beneficial ownership that we managed to push at EU level after the Panama Papers. We have seen a huge impact from LuxLeaks. Right now, EU countries are negotiating public country-by-country reporting. So I think we need to be really aware of the fact that there's huge public frustration with the system as it stands, that we do have the public on our side, and also that things are moving. But that this is really also a perspective that I think depends on where you're sitting in the world. When we talk about a global tax body under the auspices of the UN, I think sitting in Brussels looks very different from sitting in other parts of the world. And this has been a priority of the G77, which represents more than 100 developing countries for a very long time. It's brought up again and again. And I think this year is especially important because we've had some very strong recommendations from the UN faculty panel. And I'm sure many of you are following that debate, but it's been really interesting, even in Europe, to see that stimulate discussion here. And so, for example, there have already been discussions in Norway and Germany with the European Commission, and we expect to see that continue. So I would say we should be looking at how we can address the problem now and how we can change the structures, and maybe just to encourage everyone to get involved in the campaign for that work on both sides. And if you're interested in receiving more information about that or joining calls, just drop an email and we can include you in our coordination.
Thank you. And I think we have a question next from Tony Salvador.
Thanks, Luke. Thanks so much, Moran and Lucas. Extremely awesome work that you have done. Sorry, I might have missed it. Does your study include, I guess, a mapping of the countries of incorporation of the parent corporations of the entities located in the tax haven? And the reason I'm asking that is that the jurisdiction of the parent or parents may have a robust controlled foreign corporation rules that would make the parent liable anyway for taxes on income earned in the tax haven, even though there's no distribution yet, there's no payment from the entity located in the tax haven to the parent. I mean, in terms of perhaps dividends or whatever distributions there are, no, or even royalties or interests. Of course, I mean, the question may be dumb in the sense that corporations actually use tax havens precisely because their parent, I mean the jurisdiction where the parent is located does not have very strict CFC rules. Obviously, the US has very strict CFC rules. I think Germany has one too. I'm sorry, I'm not very familiar with the rest. I'm from the Philippines. Obviously, that doesn't apply to us, so we don't have CFCs. So yeah, so I don't know if the question makes sense. But thanks again for your awesome work.
Hello. So we do cover CFC rules under indicator 19. So there's like a difference in scope across countries. Maybe I can quickly here share my screen, show you the results. So these are the results. As you see, there are some countries with no CFC rules, such as Taiwan, Panama, Singapore. So those would be more favorable jurisdictions to establish a parent company or a holding company or an intermediate holding. Does that answer your question?
Yeah, but I was thinking more in terms of quantifying which part of how much of the investments in havens are actually captured by CFC rules and how much are not captured by CFC rules.
Yeah. So I think that this would be like an issue of like the statistics that we use to quantify. Like this, that there are like two components, as we said, like the qualitative one concerning the laws and the quantitative one concerning the economic flows, and that's actually like a big issue because there are striking differences on what like each jurisdiction considers to be a resident company that has to report on, for example, foreign direct investment outward or inward. So I would say that like how much like a country is the source or the target of economic activity for direct investment is taken into account to calculate our quantitative component, the global scale weight. So, like in that regard, we are quantifying. For instance, if Singapore reports the statistics on its on resident companies, those statistics will include outbound investments by the parent in other countries. So like it would be taken into account in the quantitative component.
Okay, thanks so much, Lucas.
I'm conscious that we're just slightly over time. We have two more questions. Lucas Moran, can you hang on for a couple of minutes and maybe we just finish these off? And I will, if anyone else has further questions, I'll drop my email into the chat box now. So if there's any other doubts or queries or questions, we can handle them over email. So I think I'm going to ruin pronouncing this name. Gijs Verbrak.
Gijs.
Gijs, thank you. I'm sorry.
No problem. So Gijs Verbrak from ActionAid Netherlands, and I was just wondering. Actually, I was amazed by how ineffective the EU list of non-cooperative jurisdictions actually is. So we already knew that it was inadequate, that countries were missing, but that they're actually only targeting 2% of the tax abuse enablers. That's shocking to me. And I was just wondering to what extent, or not to what extent, but did you get a reaction from the European Union on this? And in addition, since I'm from the Netherlands, I was just also wondering if there was a response from the Dutch government on this report directly to Tax Justice Network.
I don't recall a specific answer from the a specific reference from the European countries. I can say, well, of course, we consider those harmful because we have different interpretation to what is harmful or not, right? So all these indicators, we take the interpretation of the OECD as a first step, and then we consider what is robust or sufficient policy for us. This I will say as just to start with. I can say that the Dutch government was very cooperative during the process, the cycle of research. So we have to, apply for the tax authorities twice in the beginning of the cycle to get more information, and then at the end to share our results and see if they have any comments. And they were very cooperative. Of course, they did not agree with many of the things that we said, but we had a lot of correspondence between us to explain. And I don't know if it will change in the future, like if it affect the policy, but I think there was one step already of the ruling from, I don't know if we are the one that can take any credit here, but we criticized the tax ruling of the Netherlands very highly in the previous edition, and there has been a change between those editions. We still think we still have criticism on the current one, but there has been a step forward.
Just quickly on the European Union reaction, maybe not like specifically to our index, but like the European Commission is planning to review its code of conduct on business taxation, and what seems possible is like a working of the blacklisting standards. What does not appear to be possible is the elimination of this double standard for EU countries and other countries, because EU standards are subject to the European semester and thus only kind of subject to like infringement procedures if there is like a substantial macroeconomic imbalance or something like that, which is like different standard than that applicable to other countries. So like good news and bad news at the same time at the EU level.
Thank you.
And I think we also, which is one last question from Eva Danzi. Would you like to, oh, there you go.
Hi, yes, should I spell it? Yeah, no, I was just wondering if, since I'm working on Africa, I wanted to ask you if this widespread, if there any evidence of widespread use of redundancy of cost-based tax incentives, or if this is negligible, like how big is this problem? Because since you're measuring only like profit-based tax incentives, I was wondering, yeah, the dimension of the problem of cost-based tax incentives. Yeah, that was my question.
Yeah. So we have like a pilot study that has been published. I think where we do like an explorative assessment of like all tax exemptions across, I think, like 10 countries, including those cost-based ones. And what we see generally is that like global north countries more often use this cost-based incentive in comparison to global south countries. Yes, this may also be specifically for the EU, because it's subject to the state aid restrictions, and so countries try to provide incentives otherwise. I don't know if that answers your question.
Yes, thanks. Yeah.
I should unmute myself, I suppose. Okay, thank you, everyone. I guess we'll wind it up there. I momentarily got kicked out of the meeting there, but I managed to find my way back in. But yes, thanks again, everybody, for coming along today. And I'll just drop my email in there once again into the chat in case anyone thinks of any questions they might have after the event. And happy to talk about, any further questions on the CTHI or on anything else for that matter. So please do feel free to get in touch. And I think that's it for today. Thank you, everyone. A special thanks to Olivia for all her help with setting things up.
Yeah. Thank you, Olivia, and thank you all.
Can I just say thank you so much for all the work and this really amazing presentation. I think it's really useful for all of us, and really appreciate all the preparation and the willingness to do this each time you present. It's hugely valuable to the work I think we and our members are doing. So really, really appreciate it. Thank you.
Thank you so much, Olivia.
Oh, thank you.
Bye-bye.
And I hope everyone has a nice afternoon or morning or evening, depending on where you are.
Cool.
Thank you.
Take care, everybody.
Bye-bye.